Good afternoon and welcome to the RATHBONES Group PLC investor presentation for the full year 21 results. Throughout this recorded presentation, investors are being in listen-only mode. Questions are encouraged and could be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I would like to apologise for the slight delay in starting this afternoon. I'd now like to hand you over to Jennifer Mathis, Finance Director, and Paul Stockton, CEO. Good afternoon.
Good afternoon. Good afternoon. Thank you very much indeed, and nice to not see everyone. Unfortunately, it'd be great to be able to see all your faces, but we're talking into a screen, so do forgive that if we slightly miss a nuance. But we are watching the Q&A as we've just been talking about. So listen, thank you. It's a new format for us, so we're very much welcoming the opportunity of having a chance to talk directly to retail investors. So really pleased with that. Let me therefore just give a bit of a summary then. You have Paul Stockton, Chief Executive of Rathbones today, and maybe just to orientate you a little bit, to give you an idea of Rathbones at a glance after a rather messy day for investment managers yesterday. Certainly Rathbones, one of the largest independent wealth managers in the UK. We just published yesterday funds under management of 68.2 billion. And really, it's a business that's talking a lot about bespoke relationship-based investment management, together obviously with financial planning capability following the acquisition of Saunderson House last year. So a lot of heritage in Rathbones, established 1742 and all of that. So a company that's been there a long time, which of course resonates with clients that have wealth and that longevity, a very important point. Market cap of 1.1 billion. Over 300 investment managers and over 200 financial planners, as you can see here, giving a much more balanced financial planning and advisory side to Rathbones, as well as, of course, the core investment management business as well. Rathbones is also a bank, and Rathbones also has a unit trust business as well. So the financials we'll go through in a little bit, but the important thing to talk about, I think, before starting anything on Rathbones, is the translation of our heritage into a very strong culture, which is very client-centric, engaging, and collaborative. Very important in markets like we're seeing today, where as a high-touch business model, we are on the phone to our clients, reassuring them about some of the ebbs and flows of the investment markets today. And supporting that is a very robust investment process, a long way from a mixture of stockbroking models that were around 10, 15 years ago, much more institutional quality style investment process supporting the core proposition. And Rathbones, of course, has grown to 68.2 billion, not necessarily just organically. Rathbones has been very much growing through acquisition and inorganic opportunities, the last investment management acquisition being Spears and Jeffrey. So Rathbones is a place that's very much secure in a growing and secular growth market, which is the UK wealth market. We have some international businesses through Jersey, but they're a small part of what we do. We're largely UK focused. So if asked to write down what the top sort of 5 things are that help support this very strong position in the UK market, it would be a high quality brand. And that brand not only places us well in terms of being able to compete and also engage with clients, but also it's a brand that resonates with employees. It's which essentially allows us to attract the talent that we need to in growing the business. It's also a brand that gives us a lot of opportunity to invest in the future, particularly as it to resonate with the next generation of wealth and also specialisms, such as charities, such as Green Bank in ESG, is a great offshoot of our core brand. Now, of course, our distribution channels are anywhere from direct clients, but also working through third-party IFAs. And Rathbones has a very strong range of propositions to those parties as we sit here today. And that combines very much with that responsible investment capability that I was talking about before. Responsible investment is very much at the heart. ESG is not a new thing for Rathbones. ESG has been done by the Rathbones Group as a responsible investment process for over 20 years. And again, that resonates. It's not just a new fad It is something that's in our DNA. And as I said earlier, a growing advice footprint. And we are a bank as well, so we'd like to point out, of course, in a rising interest rate environment, that is quite a beneficial position to be in. 2.5 years ago, we set out a strategy which is consisting of 4 pillars: enriching the client proposition and keeping that relevant, supporting growth directly, inspiring our people because they're incredibly important to us in a client-facing business, and obviously pursuing much more operational efficiencies. And that strategy has certainly started a great deal of activity in the organisation to drive organic growth, deliver against some of those strategic priorities, and of course absorb big acquisitions that we have done, like Spears and Jeffreys. So results today are showing a funds under management growth of 24.7, PBT growth of 30.5% year on year, and that's underlying, not statutory, as Jenny will come on to in a moment, and a resilient margin of 27.7%, with a strong growth in dividend of 12.5%. So a good financial and strong financial year for Rathbones. And let me hand over to Jenny now to give you a little bit more feel for that.
Good afternoon, everyone, and thank you for joining us. So thank you, Paul. And here we've got a slide here with some very positive headline KPIs, some of which Paul has just touched on. But the strong funds under management growth and performance has driven a 19% in operating income, and I'll take you through a bit more of that detail shortly. As Paul mentioned, underlying PBT up over 30% and a statutory PBT up over 100%, of which I will touch on in a couple of slides. So let's take a look at revenue. So operating income up 19% on 2020 at 436 million. So an increase of 70 million, and more importantly, ahead of the growth in costs. So in here on this slide, to the top 2 lines of the revenue split, you'll see the investment management and funds fee income were up 25% and 39% respectively, and that's well ahead of the benchmarks at the bottom of the table that we look to, the average FTSE 100 and the average MSCI. So our strategy is to grow high quality fee income over commission income, and I hope you can see that these results bear that out. Let's just go to the next slide, and I'll take you through the rest of the revenue lines in a little bit more detail. Here I'll show you a longer timeline on the key revenue contributors, and the trends are clear. The majority of our business comes from discretionary fees, and that's grown in recent years. So to familiarise a number of you, we bought a firm called Spears and Jeffrey in Scotland in 2018, and in October 2020, we started to move those clients onto our standard discretionary tariffs. So you can see that coming through here in the basis point return on discretionary fees and the corresponding reduction on commission in the bottom left-hand chart. I'm happy to take any questions on Spears and Jeffrey later, but it's been a very successful acquisition. We've beat our target synergies. We've got a much larger footprint now in Scotland, managing over 11 billion, and culturally an absolutely wonderful fit across the business. So the other 2 revenue lines here, the top right is our advisory fee income, and this is where we split out our most recent acquisition, which was Saunderson House. So Saunderson House joined us mid-October, so there's 2.5 months of revenue and costs in these financials, and we've drawn that out there with revenue being just over 6 million. That aside, we have been investing in our own advisory businesses, so our own Rathbone financial planning business, our Vision Independent Network, our trust business, etc. And you can see that the returns there are continuing to grow since we started investing. Finally, on the bottom right, basis point return from interest income. As Paul mentioned, we have a banking license, and since rates have been suppressed since March 2020, you can clearly see that here on the chart. As these rates increase, we will see this revenue line grow in 2022.
Jenny, if I could interrupt there, there's a question from Paul S. on that impact of interest income of 100 basis points increase in interest rates. Seems to be useful to answer that one now.
Yeah, no, I'll take that one now. So today we're at 50 bits. And that will generate in the region of 8 to 10 million of net interest income this year, up from 4 million in total last year. Then for the next 1% rise, so up to 1.5%, it's in the range of 10 to 13 million, depending what markets are doing. And then it tapers off slightly because we're passing on that margin to clients, where we do pay interest back to clients who are holding cash with us. So there's some rough numbers there that will move this back up to basis point returns we've seen historically.
Okay, thanks, Paul, for the question.
Turning the slide here to take a look at costs. So as the business grew in 2021, our costs grew in line with plans and expectations, and more importantly, at a slower rate than revenue. So growing at 15% whilst facilitating our change plans is more than covered by the operating income growth of 19%. We've been talking about this in recent presentations here. We are investing to grow, to facilitate our organic growth strategy. And that investment is across a number of fronts, strategically across digital solutions, client proposition, and investing responsibly, to name just three. We've also been busy enhancing and ensuring our run the business activities are upgraded and ready to receive this digital investment that we've talked about, which will drive us having a more stable and digital friendly infrastructure and ultimately a simplified operating model going forward. So what you can see here, apologies, I've got a printer in the background that's just decided to fire up. Apologies if that's interfering with the volume. So we have increase in fixed costs, you'll see here, of just over 10%, which that reflects over 200 hires we've made in the firm in 2021. And that's across all areas of the business and quite targeted on our strategic initiatives. Variable costs are driven by the results we've brought out today and the growth in the business in funds under management and profits. And other operating expenses are up 21%. You'll see there just over £17 million. And this is as a result of the non-staff related investment I've mentioned, plus Saunderson House costs of 2.5 months. So so turning to profit, this is where I'll explain the difference you see there in underlying PBT and PBT. So a great result, 30% increase in underlying PBT is up to nearly 121 million. So a really strong performance whilst we've been investing in the business. And this has all come about through acquisition synergies, organic growth from the underlying business, and a recent acquisition, providing us the operating leverage to drive higher profits. So the Spears & Jeffrey acquisition here, you'll see in the 2020 column, there was substantial acquisition related costs. The consideration structure when we bought Spears & Jeffrey, it was an employee-owned business, and those employees remained with the firm. And so the way we had to pay for that business had to be treated as remuneration. And hence, we've been managing the business on an underlying PBT, so that these costs, which are generally capital in nature, are clearly set out. So you can see here that they have reduced substantially in 2021 as the Spears & Jeffrey deferred payments are now substantially complete. And there's a small amount in there, 3.7 million for Saunderson House, which is much smaller than the numbers we've seen before for Spears & Jeffrey because of the deal structure of that acquisition. As a result, you see better effective tax rates now coming through, and we expect that to reduce to 2 to 4 percentage points over the statutory rate of tax in 2022. And then down to EPS, basic EPS has been somewhat suppressed in recent years by that acquisition, those acquisition costs coming through. Hence, we've been pointing to underlying EPS as we talk to the markets and our investors. But what you can see now coming through in basic EPS is how growth in underlying profits are tracking much more closely in 2021. And finally, to the dividend and our track record. Whilst the dividend was uncovered in 2019 and 2020, in 2021, the dividend we've declared is fully covered by statutory earnings. And this shows that we've delivered on our progressive and sustainable dividend policy, even when statutory earnings are impacted by acquisitions. And this is what you should expect from us over time. So our dividend forms an important part of our total shareholder return, our TSR, that has consistently outperformed the FTSE All Share Index over the past 10 years. Dividends will be subject to shareholder approval at the 2022 AGM on May the 5th and dividend paid on May the 10th. So I think that is all my slides. I'll keep an eye on the questions and I will hand you back to Paul.
Yeah, Jenny, thank you. There is one in terms of the current level of surplus capital in RATHBONES from Paul S. A good name that, I thought. If you would possibly take that one, Jenny.
Yeah, happy to answer that, Paul. So yes, so despite an acquisition in the year and as guided at the time of that acquisition, our capital position remains strong and the surplus is standing at around 115 million. And that is higher than I guided at the time of the acquisition, because since the half year, we've refinanced our Tier 2 loan notes, adding just shy of 28 million to our own funds. So we as a management team expect to hold a buffer above the regulatory requirements, and as you can see, our surplus is running much higher than that. And Paul and I consistently talk how we hold this for investment in our organic growth strategy and for inorganic opportunities that are able to advance our strategy, which is what you saw us do last June in the acquisition of Saunderson House, and we're constantly looking. So hopefully that should answer that for now.
Yeah, Jenny, it does. Obviously, a couple of questions, and I think it's better that we're interactive here. There's the question from John A on in terms of management fees, which I think going back to maybe page 7 of the presentation would give you, John, a picture of what we're charging in terms of management fees. So that answers that part of your question there. I think in terms of bear in mind that there's two businesses, about 13 billion that's managed in what I would call a fund format. That's a mixture of single strategy funds and multi-asset funds, and the rest is in private client funds where obviously individual investment decisions are taken. In terms of performance on those, the latter, the performance compares favourably in the 1, 3 and 5 year categories of performance against relevant indices. So well positioned there. And in terms of the performance of some of the other single strategy funds, generally dominated by good performance in Global Opportunities Fund and indeed Ethical Bond Fund, then we've got pretty much historically some strong performance. There are 2 points I think that your question alludes to, which is the longevity of that. And certainly in the funds business, we are always trying to produce very fulsome value reports for customers of that fund, and we do that on an annual basis, and making sure that we can justify the fee that we're charging based on external benchmarks and external assessments of the value of those funds. Those reports are obviously available for each of our main funds. In terms of the performance of our main private client business, we've seen certainly a resolute revenue margin in terms of the offering there. We haven't changed our fees across RATHBONES for some time, although we did do some realignment for Spears and Jeffrey, but we're obviously focused very much on continuing to provide value there. So that was one of the first parts of your question. The second, of course, is that there are, by the way, some fee details on page 39 if you'd like any more detail. The last is about ongoing fee pressure, and of course there is a little bit of that which we try and respond to in light of any more normal commercial pressures. I wouldn't want to take over the whole presentation on pricing because that could take me some time, but I do hope, John, that's given you at least some comfort. If I go then towards the more of the business update, I'll move everybody on to slide 13, if that's okay. I could certainly try and cover some of the questions that you've raised as I'm going. So what I said earlier was a very clear strategy. I think I hope you agree here. And this is effectively what we're trying to do across the business for those 4 pillars. In terms of facing the market, it's important now that we are recognizing in RATHBONES there are solutions here that are not only facing the wealth management industry, but also the asset management industry. And both of those solutions have a B2B capability accessing the financial advice market. In wealth management, that managed fund solution is supplemented by a bespoke discretionary solution, and also our own internal financial planning capability, which is delivered by Saunderson House, Rathbone Financial Planning, and indeed a separate network called Vision. We do run some non-discretionary execution-only other business, but it's complementary to the main business. That's important because in analysing how the business has grown, we very much focus on discretionary and managed fund solutions, and they are generating, as you can see in the chart here on page 15, a 4.1% annualised growth rate. And in terms of the underlying discretionary part of the business, you can see that split very much between the direct business and indirect business, and all of those very much on a growing trend. And as you'll see from our webinar yesterday, if you can get access to it, very much looking forward to the next few years where historical investment in capacity, our approach to responsible investment, a much greater traction in the financial advice market, and opportunities from the Saunderson House, as well as our acquisition, as well as the opportunities from our multi-asset range. Performance on that has been good, by the way, and equally our new Green Bank multi-asset funds give us a very strong product set and process capability for future growth. Our funds business, as I mentioned before, includes that multi-asset business, but also equity-orientated funds and fixed income-orientated funds. And there's a question, I think, about in terms of how that's weathering some of the investment storms at the moment. And I think all to say at the moment is that very growth-orientated funds will undoubtedly have performance suffer in the short term, but we have other offerings like an income fund or a high-quality strat bond fund or high-quality bond fund that will appear to investors that have slightly lower risk appetites than some of the growth-orientated funds. So it's a highly balanced fund business, which is also supporting as well our approach to ESG. So very briefly here, Green Bank, as I said earlier, is a 20-plus year experience in this, and just launching the multi-asset fund is a strong sentiment of what our capability is. In 2021, very much focused on investment process enhancement. This isn't a greenwashing story. It's a selectively using our capability to reflect ESG factors into our security selection. And what that means is data selection, data supply, and also making up our own mind. And it's something that as a firm we take very, very seriously. Our investment managers this year were trained 100% in CISI training for responsible investment. So looking forward very much to the client engagement. As you'll be aware, we all need to engage our clients much more in terms of their ESG preferences, and our powerful stewardship track record is an important part of that proposition going forward. I mentioned our planning capability, and here you are on the slides, and this gives you a little bit more detail to what I was talking about earlier in terms of growth in number of advisors, as well as growth in number of investment managers, and also the revenue that's growing from advisory side of the business. Saunderson House is a strong acquisition for us, and yesterday we reiterated the acquisition targets that we were talking about there. I'm keen to get on to questions. Some of you have mentioned in terms of M&A and track record of acquisitions, and I'll take a couple of those questions now. John A., thank you for your question on transformational M&A. Look, in general, approach to M&A in generally is opportunistic. By its very definition, you can't just fuse together lots of opportunities in a client-orientated, people-orientated business model. But what you can do is look for cultures that are very common and similar. So there are opportunities, I still think, in the private client market and indeed in the advice market for larger M&A, but of course that increases execution risk. So very important that those cultural and synergistic assessments for any M&A business are right. As you know, Rathbones has tried in the past to get together with Smith & Williamson. That didn't happen. But that doesn't say that we're not looking at those types of opportunities on a pretty regular basis. In terms of fund management, I think the culture is even more important, but also there may well be some opportunities in terms of looking at some complementary fund mandates that we don't have in the business. But that's not a priority right now, particularly. So in terms of any other questions, I'll just go back to that for the moment on M&A, because there were a couple. In terms of multiples paid by private equity for private client businesses, yes, it is. Private equity has very much entered the market right now, and has been for some years. Those multiples are challenging and have obviously demanded a number of cost synergies as a result. So what I do expect, though, are a number of exits from private equity, because it's about that time with a sort of 4 to 5 year time frame from some of them originally investing. But equally, I also see other private equity providers being interested in the sector, mainly in terms of the ability of the sector to leverage technology, which is a nice segue in a way in terms of the plans in the future. So in terms of our digital platform, that's our plan very much, is to upgrade our digital capability. And as you can see here, going from 21 to 23, we've already started this journey by launching apps and building some of our data capability and upgrading our custody and settlement system. That means we don't have to re-platform our technology capability, but we can focus on what is going to be a major differentiator, I think, for the wealth management industry in terms of how digital impacts the client engagement. So how we prospect, how we onboard, how we service our clients is going to be absolutely crucial. But this is not building a digital channel. This is supplementing a tailored face-to-face bespoke offering that already exists within Rathbones. So fusing, if you like, the human and the digital here is our goal. And equally, given the significant growth in our fund business, putting in an institutional quality asset management system is another important part of what we're trying to do, as well as, of course, keep our My Rathbones apps and portals and client interfaces flexible. Really important point, because the client of the future is going to require Apple-like functionality, is always going to have changing preferences. So very important that we provided the budget and indeed the flexibility in the operating model to be able to achieve that. And that's why in 2023, enhancements, revisions, and ongoing development will be so much more important, which will be factored into dynamic client reporting. So really important that this isn't a soup to nuts technology spend. This is something that is very much bolted on to the very capable technology we already have. We already have the team to deliver. We already have vendors in InvestCloud, Objectway, and Charles River that are innovative and highly collaborative, working with us. It will reduce our complexity, number of systems that we're running, and it's really reassuring to see the amount of client focus that's going in design at the moment. Data quality is also very important. No point to have a technology system without data. And as I mentioned earlier, this agile approach to development is really, really important. In terms of return on that, Paul, thank you for your question. I think the return we will see in a number of areas. From an efficiency perspective, there's no question that the amount of paper that's in our organization at the moment can be significantly reduced. The amount of mailing that we're doing, the amount of emailing that we're doing, the amount of self-service that our clients are able to do and are willing to do versus our investment managers are working around at the moment is quite a sizable bit of gain here. And that will have not only a knock-on effect in terms of efficiency, productivity, to get our people working on the more valuable parts of what they do, but they will also, of course, have an impact in reducing costs and tangible costs like paper. But of course, what we're hoping for as well, with some of the other growth initiatives that we're undertaking, we're expecting a return in terms of growth that we'll be able to see coming through after we've put in some of these digital tools. So I hope that answers your question, Simon, on that. So in terms of that overall, that is our digital, and I'll hand over to Jenny to talk about the financial outlook. Well, I try and decipher some of the other questions that are happily coming in the right-hand side of my screen.
Great, thank you, Paul. Looking ahead, so we've got some exciting developments ahead in terms of digital and really that client experience journey being added onto the RATHBONES, very strong face-to-face relationship-based approach. So this is going to cost 40 million of operating expenses over the next 2 years. So that's the financial years of 2022 and 2023. And that aligns with the sort of the roadmap that Paul just outlined. The key point to note here is the expenditure will be in operating expenses, not CapEx. We're working with modern cloud-based and software as a service operating models, and so no longer developing legacy proprietary systems so they don't qualify for capital expenditure. We're confident in the momentum in the business that you've seen in the 2021 results, that this is the right time for this, and it's it was always part of the 5-year plan that Paul and I laid out in 2019. So we are taking this through the P&L, and it's being funded through growing operating leverage and profits. And ultimately, we'll end up with a simplified operating model across the group with the ability to leverage the latest digital solutions. We won't be incurring the depreciation costs from this investment over many years to come, and it will release productivity, efficiency, prospecting. So I think there was a part of a question earlier on, how do I measure the return on this investment? As Paul's touched on, is taking laborious processes away from our very skilled investment management teams, allowing them more time to prospect with clients and the tools to support that prospecting, and invest and reinvest in our capacity instead of having to just add lots more people on. Particularly in the funds business, we're going to, partnering with Charles River and big, robust, industrialized management platform there to allow that business to continue to grow in an efficient manner. So taking this all into account, our operating margin guidance, as you can see here on the slide, will continue to be a mid-20s guidance for 2022 and 2023. But beyond that, we expect to return to the higher 20s range from 2024. So operating margins returning to a range of 27 to 30% by the end of 2024. And throughout this time, you should expect us to maintain our progressive dividend policy throughout this period. So, Paul.
Jenny, thank you. I want to go to John A's question. And there's a reason, John, as an asset management business, giving 5-year funds under management targets are not helpful. Because I can tell you the funds under management at 31 December are going to be different from what they are today. Those external events are quite difficult to control. But I think what I can say is the operating margin guidance that Jenny's just given should give you a good idea in terms of when we go back to that in 2 years' time, that where we can control things, which are growth, and you're looking at an annualized growth rate of 4.1%, which we'd like to build on, and plus the fact that we can control the costs. That's reflected very much in the sort of later 20s, 27 to 29, 30% operating margin guidance that Jenny's just given. So that's the best way to judge this business. It's an asset management business, so year on year, in light of market conditions, is how we judge our success. And obviously, with a chart like the dividend chart that Jenny's just shown you, looking back with hindsight in terms of dividend growth and whether we've delivered against a progressive dividend policy will equally be as important. So that's not as clean as a nice 5-year target that we're going for, mainly because external factors impact the leveraged part of this business quite significantly. But I hope we've given you enough to do a small amount of math to get through to that. I think the last thing I wanted to say today is that this is what, in a nutshell, Rathbones model is trying to create. We have a culture inside the organisation of thinking, acting, investing, and indeed advising responsibly, as well as obviously a mission to grow client wealth and build their financial security. And that latter bit on digital is about being much more easy to do business with than we are today. And if you combine that with a personal service that is going to essentially be for both clients and advisors, blended human and digital, as I mentioned earlier, and it's supported by continued investment in investment processes, skills, depth, and advice quality, with high standards of corporate responsibility that will resonate with both clients and investors and employees, importantly, then those are really important factors that build trust, reputation, and of course long-term value and growth in what is, as I said right at the start of the presentation, a secularly growing market. So, in a nutshell, that is what we're trying to do. We're very committed to it, and we have an exciting 2022 and beyond that I hope we've been able to convey a little bit. There's one question from Paul S. In terms of income growth to maintain profits and fixed staff costs. I think, Paul, that I would probably go back and just point again to our operating margin guidance on that one, if you'll forgive me, rather than going into very specific sensitivity, if you like, on income versus cost. So I hope that kills that question satisfactorily for you. So in a nutshell, I'd like to thank you all very much for dialing in. I wish I could see you, but I can't. Hopefully the audio has been very clear, but much appreciated your time today. Thank you very much.
Paul, Jennifer, thank you. Audio has been crystal, Paul. Thank you. Thank you both so much for the presentation and being so interactive in answering all the questions that we've had come through. And ladies and gentlemen, if you do have any further questions, please do submit them just using that Q&A tab just situated on the right-hand corner of the screen. I'll give the company just a few moments if there are anything questions that further come through, but just to remind you that a recording of the presentation along with a copy of the slides and the published Q&A will be able to be accessed via your investor dashboard on the Investor Meet Company platform. By the looks of it, Paul, Jennifer, you've been too efficient in answering all the questions as we've gone, and you've given a fantastic summary there, Paul. Just in case there's any further words just to give before we conclude.
No, just a big thank you to everybody. It's a new platform for us, and it's been great to see how well it's worked, and hopefully everybody's got something out of it. So thank you again for providing it.
That's wonderful.
Thank
you both for updating investors today. Could I please ask investors not to close the session? You should be automatically redirected for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of RATHBONES Group PLC, we'd like to thank you for attending today's presentation. That concludes today's event, and good afternoon to you all.